Joining me now is Harvey Flax. He's Director of U.S. Interest Rates Futures Business Development at the parent company of the New York Stock Exchange. That's Intercontinental Exchange. Harvey, it's great to have you on the show, and welcome.
Good morning, Kristen. Thank you for having me.
We're happy to have you. What are you seeing the futures markets indicate about this upcoming meeting?
Sure. Before I jump into where the futures market is pricing this afternoon's decision, I just want to recap how they got here. Right after the November meeting, the market had to digest various comments from Fed officials in regards to the economy is strong, and we're seeing no signals that we need to rush interest rates lower. With that, the futures market priced in a 65% probability that the Fed would lower rates this afternoon. About a week later, the market received the October inflation report. That was well in line with market expectations at 2.6%. And the futures market then raised the probability of a Fed cut this afternoon to 80%. 2 Fridays ago, the market received the employment report, the November employment report. That report showed that the labor market was moderating. And of course, last week we received the November inflation report, again in line with expectations at 2.7%. That pretty much cemented, as you mentioned before, that the futures market is pricing in a 95% probability that the Fed will lower rates this afternoon by 25 basis points to a new level of 4.25% to 4.5%.
And talk to me more about the expectations for the economic summary of projections. Of course, we get that about every other meeting from the Fed and the so-called dot plot.
Yes, so the September dot plot, the last one released, indicated that the Fed was going to lower rates 250 basis points beginning with September, 100 basis points in 24, 100 basis points in 2025, and 50 additional basis points in 2026, ending with a neutral rate of 2.75 to 3%. Now, though we have a new administration coming in next month, and they have certainly articulated many economic proposals, the Fed will not consider any of that for today's dot plot, the December dot plot's release. The Fed's model requires them to basically use existing information, economic information, such as the employment report and the inflation report, as well as existing government policy, regulation, and law. However, the market does anticipate that the Fed will moderate or slow down its pace of cuts next year, and that's based purely on the current economy. Over the last 3 months since the last dot plot, the economy has been strong, and inflation has been within the Fed's target range, however sticky.
It has certainly been sticky, as you mentioned, Harvey. And how are we seeing markets interpret the impact, of course, of a new administration in the new year, and how that might impact the Fed's future policy?
Unlike the Fed, the futures market can and will try to model some of the recommendations that the new administration is coming to market with. That modeling will assume that some of those proposals do not make it into policy, that policy will take time to roll out, and then when that policy does roll out, the impact on the economy and how that meshes with the Fed's dual mandate. The futures market, with that said, is pricing in that the Fed will certainly slow down their rate of cuts next year. It's diverged about 50% from the September dot plot and is now indicating that the Fed will move 50 basis points next year and 25 basis points in 2026, ending up with a rate of 3.5 to 3.75%.
So what does that mean for mortgages, Harvey?
Well, mortgages. Well, monetary policy certainly influences the U.S. Treasury yield curve. And specific to the 30-year mortgage rate, which is about 80% of the U.S. mortgage market, the 5 to 10-year sector of that yield curve. Now, my colleagues here at ICE have created some fantastic tools to track mortgage interest rates. One of those tools, the Rate Lock Mortgage Index, which is a daily index computed from where the American consumer locks in their rates each day. And that is basically, they've tracked that rates have dropped to the lowest point in 2.5 years this past September at a 6.10. However, over the last couple of months, even though the Fed has lowered rates 75 basis points, that rate has increased to now about 6.8%, and that's just the mortgage market basically tracking the Treasury yield curve, as well as coming in line with where the futures market is considering that the Fed will lower rates next year. Another great innovative tool out of ICE is the Rate Lock Mortgage feature. That feature allows market participants to price where mortgage rates will be next year. And the June 2025 contract is implying that rates of a 30-year mortgage rate will be at 6.6%, just slightly down from where they are today.
I'm curious, Harvey, as to what you anticipate we might hear from the Fed chair this afternoon when he begins his press conference at 2:30 p.m. Eastern.
Well, that's always a challenging question. Myself, I'm sure everybody in the financial world would like to hear the chairman discuss the potential impact to monetary policy from the new administration. However, I think everybody's going to be disappointed with that. I doubt the Fed chair is going to speculate or go into the theoretical on where markets will be based on proposals.
All right, Harvey Flax, thank you so much for joining. He's a director of U.S. Interest Rates Futures Business Development at Intercontinental Exchange.
Thank you, Chris, and it was my pleasure to be here.
Thank you.